Everybody, and thank you for joining this InvestEngine webinar on our managed portfolios. I'm Andrew Prosser. I'm the head of investments at InvestEngine, and I'm joined today by investment manager Gonzalo Machado. Now, in terms of the plan for the webinar, I'm going to start off giving an overview of performance for the first 6 months of the year, and then I'm going to hand over to Gonzalo to talk about the broader macro picture. Then I'll pick up again and talk about what the portfolios are going to look like for the rest of the year. Now, the webinar should last about 45 minutes in total, so we'll hopefully be talking for 35 to 40 of those, leaving 5 to 10 minutes at the end for Q&A. So if you do want to ask questions as we're going through the presentation, you can click on the Q&A button at the bottom of your screen. The questions aren't going to be broadcast to the whole webinar chat, they're just going to come straight to us, so don't worry if you think you've got a stupid question, that's absolutely fine. Just feel free to ask away and we'll answer as many as we can at the end. Yes, that is the usual disclaimer we have on the slide there, that your capital is at risk whenever you invest. This is for UK clients only, and that none of this is financial advice. Okay, without further ado, let's get on to the first slide, please. Very good. Okay, so we're starting off here with a review of performance for the first half of 2024. So these stats are to the end of June. Our InvestEngine portfolios are on the left there. Our Growth 1 is our lowest risk portfolio. That's got about 10% in equity. And our Growth 10 at the bottom of the page is our highest risk portfolio. That's almost 100% equity. So you can see Growth 1 has gained about 1.8%-ish for the first half of this year. And performance has increased as you move up the risk categories until you reach a Growth 10, which rose about 11.7%. So it's been a good year for investors, all investors so far this year. Investors, no matter their risk profile, have seen nice positive returns. And I just checked Bloomberg a second ago. Markets are up about another 1%-ish so far in July. So we're looking all good there. We have on the slide here as well some other investment managers to compare against. We can't get data for all of our peers, so we've included the ones that we are able to find because they're either listed funds or they release performance data publicly on their websites. So it's worth noting before we do any sort of comparison, the InvestEngine returns are gross of management fees, but they're net of underlying fund fees. So if you want to do a like-for-like comparison, you can take about half of our annual management charge off, so kind of 0.125% off the InvestEngine performance to do a like-for-like comparison. In the second column there, you can see ARC, which stands for Asset Risk Consultants, and they are a UK investment consulting company. And what they do is they gather performance data from over 100 UK discretionary investment managers, and they work out what the average UK manager has returned each month. So the numbers in the ARC column represent what the average UK discretionary investment manager returned for the first 6 months of the year. The next column, we have the Vanguard Life Strategy range, which is a range of multi-asset funds from Vanguard, which have fixed equity allocations. So, for example, the Life Strategy we've got in the same row as our Growth 2 will have 20% equity, just like our Growth 2. And the Life Strategy we have in the Growth 8 row will have 80% equity, just like our Growth 8. Now, these Life Strategy funds, the Vanguard Life Strategy funds, lovely and simple, but they do tend to have quite large weightings to the UK. I think at the moment, the 100% equity Life Strategy currently holds about 20% in UK equities, which is a pretty significant bet on the UK, given that the UK is only about 3% of the global market. So when the UK does outperform, these funds will do really well, but it's a significant active bet. And overweight to the global market, which I've kind of personally found was always quite at odds with Vanguard's reputation for being passive index trackers. Anyway, next to that, we've got AJ Bell, the investment platform, who run their own funds, and we're doing pretty well compared to them as well. So performance for our managed portfolios has been pretty good so far this year against a selection of peers. Having said that, it is only 6 months. We shouldn't get too excited. Yes, we had a good last year as well, as those of you who were on the call when we went through the 2023 performance will know. But still, we're a long-term investment manager, meaning that our portfolios are built to perform over the long term. So 1 year or 6 months of performance shouldn't be affecting anybody's decision-making, either ours or our clients. So we shouldn't be paying too much attention to short-term returns. Now, moving on to the slightly more interesting bit in what drove performance in 2024. So if we can have the next slide, please. There we go, thank you. The two main performance drivers so far this year have been falling inflation rates around the world and strong levels of earnings growth. So think back to the start of the year. We started the year with inflation. It was heading in the right direction, but it was still some way before we got to our central bank target rate of 2%. The UK, as of the 1st of Jan, was at 4% inflation, US at 3.4, and Eurozone at 2.9. So we started the year having already come down significantly from the peak inflation for each region, which you can see on the graph there. Since then, the UK has continued to make good progress. Inflation is now down at the target level of 2%, which was confirmed again for the second month in a row this morning. Although persistently high core and services inflation are preventing the Bank of England from lowering rates just yet. The US is now down at 3%. This slide's slightly out of date. The US is now down at 3 rather than 3.3. And the Eurozone is also edging close to 2% now at 2.5 rather than 2.6, as you can see on the slide. So the direction of travel, very positive for markets. The debate is really now only surrounding the timing and the pace of rate cuts rather than whether any hikes are on the cards. And as long as rates are reducing, then investors feel safe to continue buying these risky assets like equities. And that's exactly what they've been doing, which has helped push markets higher. The second trend, which is on the next slide, that investors have to thank for their gains so far, has been, if we can get the next slide up, thank you, has been the continued good news around earnings growth, particularly among the leading artificial intelligence companies. And this has led to really what seemed like a never-ending streak of outperformance from these so-called Magnificent Seven stocks. So that's Nvidia, that's Apple, Amazon, Microsoft, Alphabet, Meta, and Tesla versus the rest of the market. And this disconnect between the Magnificent Seven and the rest of the market, you can see on the chart there. It shows the performance of these 7 stocks against the other 493 stocks in the S&P 500. So you can see that a portfolio of the Magnificent Seven has gained 110% since the start of 2023, but the rest, the other 493 stocks in the S&P, has only returned 16%. Now, they've managed to generate these really strong returns because they've, as a group, posted exceptionally strong earnings results in the first half of the year. And given they started 2024 as already large weights in the US market, these gains in what were already the biggest companies have kind of pulled the market up with them. So those are the two main reasons things have gone well so far this year. I'm going to come back later on to talk about portfolio construction for a little bit longer, but for now I'm going to hand over to Gonzalo to talk through the mid-year global outlook.
Thank you very much, Andy. Hello, everyone. Right, so let's jump straight into it. We've covered the first half of the year. We've seen a bunch of things that we could foresee and a bunch of things that we did not. But we have separated over InvestEngine development in 5 key themes that we think are important in defining the second half of the year. So far, 2024 has been a pretty strong year for equity and fixed income markets. We've got double-digit returns in some of the geographies on a year-to-date basis, which I'll touch upon a little bit later. But as one of the themes for 2024 carrying forward is global growth. Global growth is improving, but experiences of GDP growth vary on a country-by-country basis. Whilst the US is showing some signs of slowing down in the UK, Europe, Japan, and China, the outlook is improving. The global economy is currently experiencing modest growth due to the restrictive monetary policies we have in place, which is resulting in some below-trend yet resilient growth. Over in the UK, even though things are improving despite no rate cuts yet, the US growth has softened a little bit, whilst European growth is improving from a lower base, which has been supported by the anticipated rate cuts that we've seen earlier in the year. Economic differences are expected across regions, given that the different rates that we are experiencing, different cuts and different rate cycles we are seeing here. If we move over to the second theme, which is again inflation, we've been talking about inflation for years, but this inflation continues to be a big thing. There is progress being made again across different economies. The US disinflation story does appear to be prolonged, whereas the UK and the Eurozone are a little bit further ahead and seeing actually more meaningful progress towards the magic 2% number. Service inflation remains to be the stickiest element of the inflation number across the globe. This includes the like of the hospitality and the education sector. But what this has meant is that most central banks have delayed their decisions to ease interest rates, even though inflation has been falling across most of the economies. Over in the UK, we've touched again, as Anna just touched on, we have seen a 2% print as of this morning again, and the Bank of England is yet to action any rate cuts. In the US, growth has been resilient. The markets for the labor market has been relatively tight up until recently, and inflation surprises have delayed the disinflationary path, with only a couple of rate cuts now expected for the remainder of the year. For those of you that tuned in January, we're expecting 4 or 5 rate cuts. That seems to have been kicked down the can in every Fed meeting. Over in the Eurozone, despite slower growth compared to the US, the inflation outlook does look a lot more in line with the central bank targets, which is why we've had the first of hopefully many interest rates cuts going forward. Which brings me on to my third theme for the rest of the year, which is again rate cuts. At the start of the year, markets anticipated numerous rate cuts from central banks. However, hotter than expected first quarter inflation numbers have reduced expectations to just a few cuts. Markets are currently pricing in more rate cuts by the likes of the Bank of England, the Federal Reserve, and the central bank, but these are nowhere near what we're expecting or pricing in indeed in the in Q1. Given that the market outlook and disinflation policy has been pretty volatile, we're also expecting minimal rates for the rest of the year. Another theme that we're looking to explore is industrial policies and trade policies. That again, it's been a strong theme which is likely to continue, which will be a key regional differentiator going forward. Developed economies usually have employed more of these policies in order to protect their industries, but with the rise of China and India, for example, in the electric vehicle space and the subsequent tariffs levied by the European Union and American markets, this is just one of the topics that is likely to distort growth and corporate profits for the remainder of the year. And well, the fifth theme, it's more of a micro theme and risks adjusted. So it's small little segments that probably don't warrant their own little section. But the geopolitical risks remain high, once again highlighted by the recent events in the Middle East. The additional risks on the ongoing conflict between Russia and Ukraine, the Chinese-US tensions, and obviously the potential impact of the upcoming US election, discounting the events of the weekend so far. But elections are also a particular theme going into this year. Well, for the year, we've got 76 elections scheduled for 2024, most notably, obviously, the UK and the US and the French elections. Whilst these elections have somewhat of a limited market impact, the political and policy uncertainty does remain high. But it's also important not to discount the financial conditions that we have at the moment. So following the rapid rate hikes of, from to 2022, financial conditions have remain tight, and whilst recent incidents have been managed accordingly, with the likes of the collapse of Silicon Valley Bank and Credit Suisse, these are again events that we cannot discount. If we could possibly move on to the next slide, please. Looking into interest rates, again, this is just to bring everyone back up to scratch on what we're looking at and how far we've come in the interest rate environment. We started the year pricing in many rate cuts across the three major central banks, but only one has materialized so far. With this in mind, let's look at the next slide, which goes into slightly different regions. Thank you very much. Right, looking at the home market, so far 2024 is shaping up to be significantly better than 2023. The FTSE's delivered over 8% return so far on a total return basis. Inflation is back at 2% target, and is not, we're not forecasting it to be fluctuating much for the rest of the year. In terms of GDP growth, we had a first quarter delivering a GDP growth of 0.7%, which was way ahead consensus forecasts, which is more than enough to offset the recession we saw last year. The monthly GDP numbers also suggest that this recovery is set to continue, and the economy is due to move back into its full capacity towards the end of the year as the new government comes into play. On the inflation front, as we've touched upon a couple of times, we did indeed reach another 2% reading this morning. ever so slightly higher than expected by 0.1%, which does dampen the probability of an interest rate cut coming in August. However, pricing pressures continue to ease with energy prices declining, which again opens the door to interest rate cuts, hopefully in September. Inflation in the UK has been slower to fall versus Europe in terms of rate of change, which does put the UK ever so slightly lagging behind Europe in terms of interest rate cuts and GDP growth. This can be blamed a little bit by the energy prices in the UK and how stubborn some of the service inflation numbers have been. In terms of the UK going forward for the remainder of the year, we are now under a Labour government, which was priced in for quite some time, given that the policies don't deviate too much from the Conservatives. We are expecting a closer relationship with Europe to develop, which could reduce some of the Brexit discounts associated usually with the UK assets. But then again, we can't discount the fact that the current government has a very limited fiscal space to really shift the economy into a consensus crushing growth here. If we move on to the next slide, please. Thank you. Right, across the pond, we have an inflation story which is slightly stickier than originally expected. The S&P is well into double-digit returns. Seems to be crushing an all-time high every other day. Inflation is currently sitting at 3%. However, US growth is set to cool down in the second half of the year as consumers become more aware of the borrowing costs to fund large purchases. If we look at GDP growth, the US did lose a little bit of momentum in Q1 this year, with the GDP growth coming in at 1.4%, which is a sharp decline from the previous quarter at 3.4%. To add to this, the consumer spending has also been revised down, which has been partially offset by stronger business and residential investments. Over in the inflation front, June CPI's reading came in softer than expected, which was mainly led by housing rent and car prices, which reverts back to the consumer spending point that I made earlier. But these sectors are a large component of the inflation number. Touching on the labor market very, very quickly, which has shown signs of recent cooling the last couple of months. This is not expected to slow much further, but it does give a little bit more confidence for the Federal Reserve to deliver at least 2 rate cuts by the end of the year. At least this is what markets are pricing in. Of course, the elephant in the room here, and again, not discounting the effect of the weekend, the biggest headwind that we're seeing at the moment is obviously a presidential election. But at the moment, as things stand, we are pricing in a Trump win. The odds have jumped since the assassination attempt at the weekend. So we'll see what that space gives us. Moving on to the next slide, into the European space, we've again seen double-digit returns. Again, these numbers that you're seeing on the screen, they're to June end. If you look at them as of close yesterday, they are deep in double digit, not deep in double digits, they are in double digits. But inflation is still at 2.5%. That's fresh off this morning. The European Central Bank has been the first one to cut rates in a post-pandemic environment, as the inflation squeeze continues to ease. If we tune into GDP, as inflation decelerates, boosting spending power is boosted. It's expected the growth momentum to continue and the region to be boosted by such. GDP growth in the area is expected to be 0.3% again. It was 0.3 for the first quarter. So the big picture here is that slower inflation is supporting real incomes and spending, which is what's underpinning the faster than expected growth here. On the inflation front, as a headline inflation falls back into 2%, we are seeing an incentive for wage increases to fade away, which keeps domestic costs pressures under check. In terms of further cuts from the central bank, markets are looking at further 2 cuts, but we shall see. It's a volatile space. And on that note, I'll hand it over back to Andy.
Thank you very much. Thank you, Gonzalo. Now, in terms of what all of that good stuff means for portfolios, I started the webinar by talking about the earnings growth in those magnificent 7 stocks, and that these stocks have performed really, really well, which they have. But the performance of these few stocks has led some investors to worry that we are now in a bubble. And the things like the combination of increased market concentration and higher valuations have led some people to compare today's environment to the dot-com bubble and the subsequent crash in 2000. So I thought it was worth taking a little bit of time to interrogate that. And to investigate whether we really are in a bubble, we're going to look at 2 related questions. First one is the market too concentrated in those kind of few tech stocks? And the second one is the market too expensive at the moment? So if we start with the first question then, which should be on the next slide. We're really thinking about here whether the market is too concentrated. Now, because these magnificent stocks have generated such fantastic returns, they have inevitably become larger weighting in investors' portfolios. These 7 stocks now account for 35% of the S&P 500 and 22% of the global market, which is higher than at any point in the last 30 years, which you can see on the slide there. So the worry behind having a concentrated market is that if any of these big stocks miss earnings or have some negative news, then they're likely to fall a lot. And because they're such high weights in the index, then that'll cause the market to fall more substantially than if it was a more diversified, broader market. So the real question is this something that we should be worried about? And if we move on to the next slide, we can see that if we look elsewhere in the world, a concentrated equity market is actually pretty normal. In fact, if we look at how concentrated the US market is relative to other major markets around the world, it actually ranks pretty low on the concentration scale, as you can see on the slide. Our very own FTSE 100, that's got almost 50% weighting in the top 10 companies. Switzerland has 69% in the top 10 stocks, and Germany and France just under 60% each. Now, kind of a little caveat to that, having said that, paying attention to the US market, concentration does probably have more relevance for investors because nobody has 60% of their portfolio in Swiss stocks, and the US is about 60% of the global portfolio. But the point that the slide is really making is that concentrated equity markets are normal. And there's actually a really interesting reason that concentrated equity markets are so normal. And that's because, according to research, markets are inevitably concentrated because only a tiny, tiny handful of companies are responsible for any market's gains over the long run. And actually, most stocks end up being terrible investments, and markets only rise over time because a very, very small number of really exceptional companies produce returns high enough to offset the vast majority of underperforming stocks. And in fact, markets are so skewed that between 1990 and 2020, only 2.4% of global stocks accounted for the entirety of global stock market wealth created. And not only that, but over half of the stocks, 55%, actually underperformed 1 month US Treasury bills over the period. In mathematical terms, this is called like positive skewness. And it's a finding which has been replicated in lots of different studies. And I think it's a really interesting, fascinating finding. And it really shows just how difficult individual stock selection is. Active stock pickers, so those investors who try and pick stocks which they think are going to outperform the market, have a really impossible job because they need to find those tiny minority of stocks which will generate all the wealth. And if they don't find them, and the odds are that they won't because there's so few of them, then the active manager will, with almost mathematical certainty, underperform the broad market, which by definition will always hold all of those super stocks which drive returns. So the moral of the story is that finding the needle in the haystack is a really, really difficult task and pretty much impossible to do repeatedly on a consistent basis. Whereas investors holding broad, diversified ETF portfolios, on the other hand, will always hold those tiny minority of stocks. So they don't need to look for that needle in the haystack. They just simply buy the haystack. So that brings us back to the point on concentration. This idea that markets are driven by a small handful of stocks means that a concentrated market isn't necessarily something to be worried about and doesn't mean we're in a bubble. But one other thing which investors have been calling attention to recently is valuations. And really the question here is whether markets are becoming too expensive and becoming kind of untethered from reality, which is really what happened before the dot-com crash in 2000. So that's the next thing that we're going to have a look at, and we're already on the right slide. Excellent. Now, a bit of kind of jargon nomenclature. What I mean when I say too expensive is that the ratio between a stock market's price and its earnings has diverged significantly. So usually price to earnings ratios tend to be mean reverting, i.e. when they get too high, they come back down, and when they get too low, they come back up. And that's because when a PE ratio gets too high, i.e. when the ratio between a stock's price and a stock's earnings gets too high, there's a limit to how many multiples of 1 year's worth of earnings investors are willing to pay. So the price starts to come down. And then again, on the flip side, when the ratio gets too low, then investors will tend to start buying and pushing the price back up when they think the price has fallen low enough that it's now become a good deal. And research has shown that high valuations are often accompanied by lower long-term returns and lower valuations by higher long-term returns. So to start off with, if we look at the S&P's current valuation, which we have on the slide here, we can see that the US is trading some way above its long-term average. You can see the long-term average in pink there. You can see we've got the long-term average, that's a cyclically adjusted PE, about 18 times earnings in pink versus where it's currently trading, which is 34 times earnings in blue. So based on this, those investors who point out that the US market is expensive, they're correct. The S&P is expensive relative to its history, there's no doubt about that. But an expensive market alone doesn't cause a market crash. Now, we've covered off a few reasons why an expensive market doesn't mean there's going to be a crash in the half-year market commentary where the slide comes from. But just to touch on a couple here, the first one you can kind of eyeball from the chart here. You can see that markets can remain really expensive or really cheap for a long time, sometimes decades before reverting towards their long-term average. So there's no guarantee that they can't remain this expensive or become even more so over the next decade, maybe 2 decades. You can just see on the chart there, the blue line spends a lot of time above that pink average line. Secondly, the world changes over time. The US market looks very different today than it did back in 1900, which is where this chart goes back to. And it might not be fair to compare valuations today to valuations from over 100 years ago, which would mean there's no reason for today's companies to revert to the averages created from companies which existed almost 100 years ago. So while it's true that the market is expensive, it doesn't necessarily mean that it's due to fall. And it definitely doesn't mean that it's guaranteed to fall soon. So just to examine a little bit more closely the idea that we might be in a tech stock bubble at the moment, the next bit I wanted to have a look at is how does today compare against the last time we had this real tech dominance that we're seeing today. So we're just going to have a look at what the world looked like in the year 1999, just before the dot-com crash. So this table here at the top shows that we're still some way off dot-com levels of valuations for the US market. We're at about 23 times forward earnings versus 30 times in the dot-com bubble. And then if we look on the second row, the price to free cash flow, we're at 33 times free cash flow versus 56 times in 1999. And what that really tells us is that while the performance of the US market has been really strong, earnings and cash flows have also grown alongside prices this time, which they didn't do in 2000. Investors back then, they were paying more for companies which were generating lower earnings and lower cash flows. And the result is that today's valuations look much, much more reasonable compared to those in 1999. Now, a little kind of footnote here, a little caveat to bear in mind. The PE ratios, so the top line there, those are based on expected earnings growth. So should that growth not live up to expectations, and those growth expectations are listed in the lower table there, then the stocks may in reality be more expensive than they appear here. And again, if you're an optimist, the reverse is also possible. Stocks might be cheaper than they appear here if earnings grow more than expected, which is what's happened so far this year. The AI-linked stocks have just totally blown away earnings expectations. So just looking at the earnings expectations for this time next year, there's still risk that these stocks don't live up to expectations, and stocks like Nvidia, which have these really ambitious growth forecasts, if they don't meet those expectations, then they may well be punished by the market. So if we move away from looking at the whole US market and go on to the next slide and instead focus on the areas, on the area of the market that looks probably that most investors are looking at and worried about at the moment, which is those few large tech stocks, then we can do an interesting comparison of the valuations of these individual companies versus the larger stocks before the dot-com bubble burst. These stats here, they're all based on trailing 12-month PE, so nothing forward-looking here. But even based on trailing earnings, the market is looking cheaper today than it was in 1999, with a median PE for the 10 largest stocks of 31 times earnings versus 53 in 1999. And it's also interesting, I think, to see some of the sky-high valuations that the largest stocks commanded before the dot-com crash. We had Cisco, that's on the slide there, over 200 times earnings. We've got Microsoft, Cisco, Pfizer, all were more expensive than Nvidia is today. And also interesting that Nokia was trading at the same PE as Nvidia's current valuation. But either way, whether looking at historic or forward earnings expectations, comparing the current group of mega caps to the valuations we were seeing for the larger stocks during the run up to the dot-com crash, today's valuations are much more reasonable. So while it is true that the big companies today have a high bar to clear if they're able to continue demanding such a premium, their valuations are still some way off those really high levels that we saw in 1999. And that kind of leads us on to the next question, which I think is an interesting one, which is that if market concentration isn't necessarily cause for concern, and if valuations are still some way away from this bubble territory, then does it mean that the current set of companies are just going to continue to dominate? Should investors just keep buying these AI stocks and just not doing anything else? So the short answer, which is part of the answer is in this slide here. The short answer is that if we look at history, the answer is that we probably shouldn't just be buying AI stocks. So history suggests that the largest stocks don't stay the largest forever. So if we look back at the top 10 companies by decade, which we've got on the slide there, it shows the market doesn't let stocks get too comfortable at the top. So the largest companies in 1980, dominated by these big oil companies, they largely disappeared from the top 10 by 1990. Then in 1990, when Japan was set to take over the world, that was the peak of the Japan asset bubble, those largest companies followed the same fate. And they were replaced by an entirely new set in 2000. Then the tech crash came for those companies. And then by the next decade, they'd all been replaced by the rising Chinese companies. And then in turn, they've been replaced as well. And 2020 saw the start of today's well-known tech dominance, with the top 10 pretty stuffed with technology companies. So if history is anything to go by, then the next decade may see a new set of companies rising to the top. And the next slide puts that in quite nice graphical form. I always prefer looking at graphs and tables. And this picture comes from US hedge fund Bridgewater Research. And it shows the paths of all of the previous top 10 companies by each decade, and their performance before they made it into the top 10, which are all the lines to the left of that central red line there. And then those same companies' performances after they made it into the top 10, which are all the lines to the right of that red central line. And I think the few main things when I first saw this chart that really struck me were that firstly, a group of top 10 companies runs a really strong performance relative to the market in the years leading up to them becoming in the top 10, which does kind of make sense because after, you kind of need a sustained run of strong performance for a company to break into the top 10. But then after that company makes it into the top 10, or after that top 10 cohort is solidified, its best days tend to be behind it. Those stocks go on to underperform the market and see their market share shrink. The current top 10 is in blue there. And it was interesting to see that no other group of top 10 companies had so small a share of the market 10 years before becoming the top 10. And today's group now have the largest market share of any top 10 in history. Obviously, that's in large part thanks to Nvidia's meteoric rise on the back of their AI chips, but it's still really interesting to see just how quickly this set of stocks has risen to where they are. But anyway, I think the main takeaway for investors from this chart is that we should remember to diversify away from simply holding the largest stocks. They're not going to rise forever. And this finding that the largest stocks go on to underperform isn't unique. It's been replicated elsewhere, most notably by Dimensional Fund Advisors. They update a similar study every year and find exactly the same thing. So although it is really tempting to chase the performance of individual stocks, staying diversified by holding lots of different stocks in a fund or an ETF means you're more protected if they do go on to underperform, which history suggests that they might. So anyway, that's a quick sales pitch for staying diversified at the security level. But especially at the moment, it's also important that investors remember to diversify across geographies as well. Now, this is relevant for all investors, but I think particularly for younger investors who have experienced nothing but US exceptionalism since starting their investing journey. And this slide here really shows that what we saw with companies, that the largest ones tend to underperform after they become the largest, can also happen with countries as well. And it's a phenomenon called mean reversion. And it doesn't just exist at the company level. It's equally present at the regional level as well. So the chart on the slide there shows the difference between the rolling 5-year returns of the US market versus the rest of the world, using the MSCI EFA as a proxy for the rest of the world. And that index covers Europe, Australasia, Far East. And if we kind of look at that graph from right to left rather than left to right, you can see that while the US has enjoyed a really long stretch of outperformance versus the rest of the world since 2008, in the decade prior, i.e. from 1998 to 2008, it was the rest of the world which outperformed. And then similarly, the US outperformed for much of the previous decade between 1988 and 1998. And then again, the decade before that, it was the rest of the world outperforming. So really, just as markets are cyclical, so are the valuations of individual stocks, and so are the performances of regions and countries. And I think the point of thinking about markets like this is to help investors avoid that trap of only buying what's worked well recently. Because yes, while the US has done well recently, it may not always be that way. And if history is our guide, then diversifying internationally remains a sensible choice. And this next slide shows that not only does the cyclical nature of markets suggest that diversification remains a good idea, but a little bit of a look at valuations helps us understand a bit more the case for looking outside of the US. So this chart shows that the US, it is the most expensive market, both when looking at forward earnings multiples and also on free cash flow multiples. Elsewhere in the world, valuations are looking much more attractive. China, we've got there almost in the single digits on earnings multiples, and European countries looking relatively cheap pretty much across the board. The US is trading at a kind of 60%-ish premium to Europe on a forward earnings basis and a 75% premium to emerging markets. And it's also worth bearing in mind, especially when you think about earnings, that these are based on forward earnings, so expected earnings, which, as mentioned, are a pretty high bar for these US companies to clear. So again, if we put our faith in mean reversion and the historic relationship between valuations and long-term returns, the case for diversifying outside the US becomes even stronger. Now, I've just got one last slide to run through here before I kind of sum up. It's just a final look at why investors should consider diversifying outside the US by looking at the different side of the coin, which is risk. Everyone focuses a lot on returns, but risk is equally important. And this chart here is taken from Morningstar data, so it's in dollars rather than sterling. But the findings are equally applicable to sterling-based investors. And what it shows is that if you look back over every 10-year rolling period going back to 1950, then in real terms, the worst outcome you could have ended up with had you invested $1,000 was that your $1,000 shrunk in real terms to $655 if you'd only invested in the US, but would have shrunk to $886 if you'd invested outside the US. So again, it's the absolute worst 10-year performance in real terms, so includes inflation. And that's obviously what we're seeing on the slide here is obviously a combination of market crashes combined with inflation eroding away the initial capital, which is why both figures are lower than the initial investment. But the point is that it shows that the US isn't just some money-making machine which only ever goes up. There have been long chunks of time where the US market has lost money in real terms and where you would have been better off investing outside the US. So diversifying by investing in a global portfolio rather than just in the US does protect investors if the US market doesn't perform as well as investors might expect. So just on to the next slide. It's my final slide before I hand back over to Gonzalo to just summarize quickly. We've had a really good start to the year. Falling inflation, falling earnings and rising earnings growth has been a really good tailwind for us. There have been some concerns about the US market becoming overly concentrated, but the US remains less concentrated than most other large markets around the world. And it's also, I think, always worth bearing in mind that concentration remains a feature of the markets rather than a bug, and that the overwhelming majority of the market's returns have always been and will always be generated by a tiny minority of stocks, which is why it's a great reason to stay diversified and just buy the haystack. Yes, the US market is looking expensive relative to its long-term history, but an expensive market doesn't mean a crash is imminent. Looking at today's market leaders, these companies are generating more in cash flow and earnings relative to their prices than the companies in the dot-com bubble. And both today's market and today's largest companies are cheaper than they were in 2000. Now, having said that, the largest companies don't stay the same forever. They don't stay the largest forever. And staying diversified by holding lots of different stocks in an ETF or a portfolio of ETFs means that you're going to be more protected if there's a significant rotation, as there has been in every decade before now. So if we look at things from a regional level, the US is still significantly more expensive than almost all other countries, and there are plenty of high quality companies located outside the US. Just to stress, I'm not saying investors should abandon the US altogether. It's obviously an exceptional market with some incredibly well-run companies. And who knows, these companies may well continue to perform for longer than any that have existed in history so far. You know, it's not a totally unrealistic thought. But what a well-diversified portfolio does, though, is protect investors just in case yesterday's winners don't become tomorrow's winners, and it mitigates potential losses should investors' bets be proved wrong. Which is why our managed portfolios remain diversified across all regions, sectors, companies, asset classes, currencies. We can't know the future, nobody can, but what we can do is construct portfolios which remain robust throughout market cycles, and which aren't dependent on the performance of any single region or, importantly, any handful of companies. Now, with that, I'm just going to pass over to Gonzalo to take us on the last section. Please keep the questions coming. We probably have another kind of 5-10 minutes before we start looking at the Q&A. So please get them in. But Gonzalo, over to you.
Thank you very much. Well, on the back of that, some of you are already invested in managed portfolios. Some of you are thinking about it, but we'll just touch on 2 further points that Andy has alluded to. One of them is obviously, thanks to the rise of ETFs and passive investing, the cost of investing have come down significantly from the days of the mutual fund back in the 90s and 2000s. But what this means, over the long term, at InvestEngine, we are great believers in investing for the long term, and fees do have a meaningful impact during everyone's investment journey. The 3% fee does hinder investment returns quite significantly, and some of the wealth managers in the UK, some of the slightly pricier ones, are still exercising some of these fees. But it means that we, at InvestEngine, we're 25 basis points, 0.25%, one of the lowest ones out there. But investors should stay concerned about their costs of investments. Even with mutual fund tracker funds, there's costs associated with everything, but investors will be impacted by the effective fees, and it's always important to have a look at. If we move on to the next slide, for those that I don't know, at InvestEngine we have 10 growth too quick. There we go. We're back in the room. At InvestEngine we have 10 growth portfolios, growth 1 all the way to growth 10. Growth 10 being the riskiest one, which is comprised of near enough 100% equities, and growth 1 being mostly dominated by fixed income. All of our portfolios are made up of ETFs, which again are a set of securities that perform in line with an index they're tracking. But as an example, we are looking at growth 6, which is almost right back in the middle of a 60-40 portfolio, where 60% sits in the equity space, 40% sits in bonds. It is obviously no news to anyone that most of the portfolio sits in the US, both in the income, in fixed income and the equity space. But ultimately, we have a set of ETFs here that allows us to have exposure to over 10,000 underlying securities for a pretty sophisticated level of diversification at a pretty inexpensive price. In the equity space, we've got a little bit of allocation into smart beta, just to capture a little bit of extra alpha during particular times in the economic cycle. In the fixed income space, we have short duration bonds, we have inflation-linked bonds, some money market exposure given the risk-free rate is where it is. But ultimately, these portfolios are pretty much built for the long term, and they're incredibly diversified and cost efficient. Absolutely. Do you want to
I'm going to take some. I'm going to take some. So yeah, we had the option of people to email in and ask questions. So I know we might run over by a couple of minutes. We got 5:45 as our scheduled time, but let's just take a couple. So we had one client email in. I saw there's a couple other questions in the chat that asked the same question, which is about how we select ETFs and how many ETFs we include in managed portfolios. So I'd say that there's lots of factors that go into determining not only how many ETFs we include in portfolios, but also which ETFs we choose. So in terms of the number of ETFs, I'd say there's no set minimal maximum. What's more important than how many is kind of what they're invested in. So we'll only really buy ETFs which complement the overall portfolio, and which kind of when combined create a really strong diversified portfolio. So we'll buy ETFs which do different things and target different areas of the market, whether that's the equity market or the bond market. For equities, we'll choose ETFs which target different regions of the world or different risk factors. And for bonds, we'll choose ETFs which target different levels of duration or credit quality or inflation protection. And then within that, there are kind of lots of nuances around which specific ETFs we'll include. And we'll consider all sorts of variables. Obviously, cost is a big one. But there's also interesting things like replication method, which can have some tax advantages if we're investing in US or China. Securities lending practices, how much of the ETF basket does the ETF issuer lend out to third parties, and how much of the revenue they receive for that securities lending do they then rebate back to the fund? What does their tracking error look like? What's their liquidity like? We'll weigh up all those factors, and then we'll decide which ETFs warrant inclusion in the portfolios based on a kind of a holistic review of all those factors. What else have we got? Yes, we had another person email in, and I think I saw something else in the chat come up about this, which is about rebalancing. So I'll just take that one quickly as well. Basically, the question is, how often do we rebalance, and how's the rebalancing sorted? So what happens with the managed portfolios is that all the portfolios are monitored daily by our kind of internal software, which we call the engine. And if any of the weights in the managed portfolio ETFs exceed our tolerances, which we've set, i.e. if any ETF gets too big or too small, then the portfolios will be automatically rebalanced back to target weights. So it really depends on market conditions how often portfolios are rebalanced. But then that kind of leads on to another question, which I haven't seen asked, but I think I'm going to answer anyway, which is how often we make these asset allocation decisions. And the answer to that is that although we monitor the portfolio's performances on a daily basis, as we mentioned, we're a long-term investment manager. We don't want to be buying and selling things quickly and making big changes to portfolios on a really short time horizon. So we have a quarterly investment committee meeting where myself, Gonzalo, and the rest of the investment committee get around a table or virtual table and discusses the portfolios. It's not always guaranteed that we'll make changes, but we'll at least always talk about performance of all the individual ETFs and the portfolio as a whole, what's working well, what's not working so well, where we can improve things, and then if necessary, make changes to the composition of the portfolios. Right, I reckon we'll give it till 10:02 because we have overrun a little bit. Gonzalo, have you got any questions you had your eye on?
Yeah, we've had one coming in from the floor about do your managed growth portfolios include any options for investing in ESG or SRI funds? For those ones not familiar with ESG or SRI funds, ESG are the and SRI, the socially responsible investment funds. We have looked at this at length, frankly, for 2 years now. And the shortest answer here is, SRI and ESG has come into a little bit of heat over the last 12 to 18 months with a lot of greenwashing, a lot of funds being derated, upgraded. The regulatory environment as things stand with ESG funds is just not clear enough. You couple that with the outflows that we've been seeing over the last 18 months again, and ESG has really fallen out of favor. Not to say there's not an investment demand in the future, but at present they don't include any SRI funds. It's not really something we're looking into in the short future, but it is a space that we're monitoring. But thank you very much for your question.
Yeah. Right, that brings us to 10:02. So apologies, we've run a little bit late. If you asked a question but we didn't get to answer it, we've copy and pasted all the questions, so we'll do our best to have a look at them because I know that there was quite a few questions coming in that we didn't get to answer, and we will endeavour to answer them and then get back to you after the webinar is finished. So all that leaves me to say is big thank you to Gonzalo for presenting, and thank you to all of you for taking the time to tune in. If you want to find out more about our managed portfolios, then you can head over to our website or check them out on the InvestEngine app. So thank you all for joining and see you next time.